Hi everyone, this is Bronson with Nighthawk Equity. This is the passive investing company of Michael Blanc, and I'm here with Michael Blanc, so welcome Michael.
Bronson, awesome, good to see you.
Good to see you as well. So a question comes up often, and many people are wondering, how do I get paid when I invest in a passive investing deal? So maybe can you talk to our investors about, just our audience, about how people get paid and how much they get paid?
Yeah, so there's three ways you can essentially get paid as a passive investor. One is cash flow distributions, cash out refinance, and then when we actually sell the property. So we can talk about each one in turn. Let's talk about the cash flow distributions first of all. So the question is how frequently are cash flow distributions made? This varies from from syndicator or operator to operator, and it also depends on the project. For example, if it's a stable value add deal, and the distributions can be made quarterly, sometimes monthly. As soon as after we close, we can start making cash flow distributions because there's already cash flow. We're already buying the cash flow, and we're going to improve that, but there's already cash flow there. If it's a value add deal, that first cash flow distributions might be delayed by 6 months or 12 months, depending on the situation. Typically, there's guidance up front saying, hey, we anticipate the first distribution is made in wherever the case may be. So, so that's the first source. Any questions on the cash flow distributions?
I think you covered it, but just, sometimes it's monthly, sometimes it's quarterly, and sometimes there can be a little delay in the beginning, so I'm glad you covered that. One thing that I wanted to cover kind of moving along is just that as you kind of go through a deal and maybe the plan has been worked, there's been value added to the deal, there's the potential for a cash out refinance. Can you talk about what that means and what that looks like for investors?
Yeah, so cash out refunds means that we have a value add deal and we have increased the net operating income and therefore the value, and now we can refinance at a higher valuation, pay off the previous loan and the investors, and then hold it. And so, for example, we did this recently with a 321 units in Memphis called Country View. We bought it for roughly $7 million, put $1 million into it, so now we're $8 million into it. And then 13 months later, we refinanced it at a $15 million valuation, which is really cool. And so we were able to return 84% of the investors' capital in that one deal. And so they continue owning. What happens is they get the majority of their principal back, and that reduces the risk because they have their money back, and now they can invest it in a new deal and get another return on that money. So it's really, really cool. It's like, I think you talk about this idea of an infinite return. And so the other cool thing is the investors, they're not out of this deal. They still own whatever equity they have in the deal. They own that, and they continue getting distribution checks on that. So that's another way that investors can get paid.
Yeah, that's awesome. That's really a home run when that happens, when the ability is to refinance and take money and pay our investors back as soon as we can. So I know we love doing that. Other syndicators love doing the same. So talk to us for a minute. This question comes up to really understanding the different types of returns. Cash on cash. What does that mean when a deal has a certain amount of cash on cash per year?
Yeah, so cash on cash is let's say you invest $100,000. And let's say every year you get $7,000 of cash flow distributions made. That means it's $7,000 you get divided by the $100,000 you invested. It's a 7% cash on cash return. Typically, our projects, we're targeting between a 7 and 9% cash on cash return upon stabilization. Okay, what does that mean? That means that, let's say we're doing a value add deal. When we buy the deal, it's going to have some cash flow, but maybe the cash on cash is 3% or something because we're building value, right? We're renovating, we're increasing the income, and so therefore the cash on cash return will continue to go up. And really what we want to do is we want to be at our target cash on cash return no later than year 2, right? So it shouldn't take us 5 years to get to the point where we consider this deal stabilized. So that's a cash on cash return, and that's kind of our target, somewhere between 7 and 9%. We want to get there as quickly as possible.
Thanks, Michael. This has been really valuable. I know for folks that are listening, typically one thing we didn't mention, the life of deals that we do are typically 5 to 7 years, and there's also the return when the property is sold, hopefully sooner in the case of a refinance or other sorts of distributions. But the next steps, just want to touch base on the next steps for people that are listening, for our audience. Maybe you're listening and this is kind of new to you and you want to learn more. Well, there's a great report Michael put together. It really is awesome because it compares, it's like a case study on the stock market versus multifamily syndicated real estate, and it's very compelling. And it's a free report. It's at themichaelblanc.com/report. I encourage everyone to go check that out. Secondly, a question I get a lot is, how do I find out about deals? How do I get in deal flow? How do I find out about things that are happening? I really want to invest. Well, if you go to nighthawkequity.com/join, we'll start a relationship with you. We'll schedule a call, and we'll find out how we can actually work together in the future to do deals. So thanks so much for joining us, and we'll see you on the next video.
All right, before you go, download that special report right here. All right, subscribe to my YouTube channel because I'm putting out stuff every single week. You don't want to miss it. And hey, check out this other video.